Unlock the secrets to building a $1 million portfolio, demystifying wealth creation for the everyday investor on any budget. Hey there, financial enthusiasts. If you've ever wondered how to turn your investment portfolio into a $1 million powerhouse without spending hours researching individual stocks, you're in the right place. Today, we're diving into the wisdom of the Oracle of Omaha himself, Warren Buffett, as he shares a straightforward strategy that could potentially save you $500,000 in your investment journey. So, without further ado, let's begin. Warren Buffett's advice on index funds. Now let's get straight to the heart of Warren's advice. A viewer once asked him about the best way to own common stocks, and without hesitation, Buffett pointed to the power of index funds. He specifically recommended a broad index like the S&P 500, emphasizing the importance of minimal fees. In the world of index funds, Vanguard caught Buffett's eye due to its low costs. But why index funds? Buffett breaks it down. The idea is simple. If you believe in the long-term success of American businesses, but lack the expertise to pick individual winners, index funds provide a diversified and cost-effective solution. Buffett suggests spreading your investments over time, avoiding the gamble of timing the market. He dismisses the idea of specific metrics like price-to-earnings ratios as reliable indicators, highlighting the complexity of the market. Addressing concerns about high prices. Now, let's delve deeper into Warren Buffett's consideration of the concern regarding high-priced common stocks. While initially expressing skepticism about living long enough to witness such a scenario, Buffett acknowledges its possibility. However, he argues that even if stocks were to reach and sustain unprecedented high prices, index funds could still offer a reasonable return. The key lies in the duration of this high-priced environment. For an investor, enduring a prolonged period of elevated stock prices may yield a modest return of 3 or 4%. Yet Buffett poses a critical question. Would any other investment avenue offer significantly better returns under similar circumstances? Drawing parallels with Japan's experience, where a similar situation unfolded, Buffett highlights the negative returns from owning an index over the past 13 years. However, the alternative in Japan was limited to deposits in banks or Japanese bonds, offering meager returns ranging from 0 to 1 or 1.5%. This comparison underscores the resilience of index funds even in challenging market conditions, positioning them as a viable and potentially superior choice in the face of uncertain and high-priced markets. Understanding index funds. Now let's enhance our comprehension of index funds. These financial instruments, whether mutual funds or exchange-traded funds, ETFs, are crafted to mirror or track the components of a specific market index, with the S&P 500 being a prime example. The credit for this financial innovation goes to Jack Bogle, whose introduction of the Vanguard 500 fund in 1976 marked the inception of retail-friendly index funds. Despite a modest start, index funds, particularly the Vanguard 500 fund, have burgeoned over time, currently boasting over $550 billion in assets under management. Their appeal lies in their simplicity and the ability to offer investors a slice of the entire market. As a passive investment strategy, index funds mitigate the need for constant monitoring and decision-making associated with actively managed funds. This makes them an attractive option for individuals who prefer a hands-off approach to investing, allowing for a more straightforward and stress-free wealth-building experience. The 3 main benefits of index funds. Now that we've established the groundwork, let's delve deeper into the 3 primary benefits of index funds, shedding light on why these financial instruments have become a cornerstone of many successful investment portfolios. 1. Low cost. Warren Buffett's emphasis on minimizing fees is not a mere financial footnote, it's a game changer. The beauty of index funds lies in their cost efficiency, a factor that can significantly impact your wealth accumulation over the long haul. Let's illustrate this with a scenario. Consider 2 hypothetical funds. Fund A, an actively managed fund charging a 1% annual fee, and Fund B, a passive index fund with a mere 0.1% fee. Assuming both funds achieve an identical 8% annual return before fees, Let's project their performance over 40 years. At the end of this period, Fund A, burdened by its 1% fee, would amass just under $2 million. In stark contrast, Fund B, with its minimal 0.1% fee, would skyrocket to an astonishing $2.5 million. That's a staggering difference of over $500,000. This vividly illustrates the substantial impact of low fees on your ultimate investment outcome. 2. Time efficiency. Time, a precious commodity, often stands as a barrier between individuals and active investment management. While some revel in the intricacies of dissecting financial reports and analyzing market trends, not everyone has the luxury to dedicate hours to investment research. This is where index funds shine, offering a solution that aligns with the realities of our busy lives. Index funds require virtually no active management on your part. You don't need to scour financial news, analyze quarterly reports, or stay awake at night worrying about market fluctuations. This hands-off approach is a breath of fresh air for those who prefer simplicity in their financial endeavors. By merely investing a set amount regularly into a diversified index fund, you can confidently navigate the complexities of the stock market without sacrificing your valuable time. This time efficiency is a boon, allowing you to focus on your career, family, and personal pursuits while your investment portfolio steadily grows in the background. 3. Market performance. One of the key selling points of index funds is their ability to align your investment returns with the broader market. While this might seem mundane, it's a powerful risk mitigation strategy. With actively managed funds, there's always the looming specter of underperformance. The individual or team managing the fund may make decisions that lead to subpar returns, jeopardizing your financial goals. By opting for an index fund, you're essentially saying, "I'm content with the market's performance." This ensures that your investment returns mimic the overall trajectory of the stock market. While this might sound conservative, it's a double-edged sword. The potential drawback of index funds. While the virtues of index funds are extolled, it's crucial to recognize a potential drawback inherent in their design. The very characteristic that ensures their stability, alignment with the overall market performance, can be seen as a limitation. If you possess the knowledge and skill to consistently outperform the market, opting for individual stock selection could lead to substantially higher returns. Consider an investor adept at achieving a remarkable 12% annual return. In this scenario, the portfolio's value would soar to an impressive $7.6 million over 40 years, eclipsing the returns of an index fund that simply mirrors the market. This example underscores the trade-off. While index funds provide security and eliminate the risk of underperformance, they cap your potential for extraordinary gains. The decision between the stability of market-matching returns and the allure of potentially surpassing the market lies at the heart of the investor's dilemma, making it imperative to assess personal risk tolerance and financial goals when crafting an investment strategy. Well, that's it for today's video. What do you think about this? Let us know in the comment section down below. And if you found this informative, then don't forget to hit that like button and subscribe to our channel No Money for more amazing content. Thanks for watching, and until next time, happy investing.